Hi, this example to show you how to do the journal entry related to long-term debt liability by using the tables. Okay, I know we have a couple of examples using Excel, but this example is a good way for you to review how to use the tables to solve the present value question. Okay, so let's read this question together. The company issue 100,000 face value, 8% term bond, and the maturity is 5 years later. What you have to pay attention is the company pay interest twice per year. Therefore, it's twice per year compounding. And when the company decide to issue bond, right? And they decide a couple of things, how much they want to issue and what is the interest rate they want to pay. And here they choose 8% and they choose pay twice per year. And when it goes to the market and to issue the bond, the investor will assess the risk of the issuer, and based on the how risky the issuer is and the interest structure, the investor decide, hey, I'm going to pay a 6% real interest rate. Therefore, in this case, the market rate is 6%. And again, I wanted to really emphasize this. 8% is the stated rate, which is decided by the company who is issuing the bond. This 8% reflect the preference, how the company like to construct their cash flow structure, but it has nothing to do with the actual interest rate the company is paying for borrowing. And when the company issue the bond, go to the open market, the investor are the one who decide how much they are willing to pay for this bond investment. And therefore, based on the company, how risky it is, the investor decided to pay 6%. So the 6% is the real market rate or the borrowing cost for the firm. Okay, and so here, to be able to do the journal entry, we first have to identify is this had a discount or premium. How do we know? The way we decide, is this insurance issue at a premium or discount, really depending on how much money you get when you issue it. And in other words, what is the present value of this bond? And so here I wanted to show you how we're going to use the table to solve this. First, you have to really set up the question. So if you look at the question I'm setting up here, n is equal to 10, I is equal to 3. So how do I know n is equal to 3? N is equal to 10. From 2012 to 2017, there are 5 years twice compounding. So you take a 5 multiplied by 2, which give you 10. And how did I get I equal to 3? I take the effective rate, which is 6% divided by 2, because you compound twice per year. Therefore, n is equal to 10, I is equal to 6. And this is the input we're going to use when we use the tables to looking for the present value discount factor. Before we can use the table, we must calculate two things. The first is the cash interest. And cash interest here is 4,000. So how do I know it's 4,000? This is just going to be the principal multiplied by 8% and divided by 2. Okay. So I know the cash interest is 4,000, and this is ordinary annuity. If you think of the cash flow pattern, because the company has to pay out 4,000 every 6 months at the end of 6 months. The next one is the principal, which is just a single sum in terms of cash flow pattern, because you only need to pay it once. Okay. All right, so after we have this, we can use the tables. The first we're gonna look at the table is called the present value of ordinary annuity table. And this table is the table 5 in the time value money table. And here, I'm just going to switch to the table we have. And just remember, n is equal to 10, I is equal to 3%. And therefore, here we go to look at the table. So this is how the table looks like. On the top of each table, they tell you exactly what that table is, okay? So what we're looking for is we're looking for something called a table 4. and it's called the present value of an ordinary annuity. And here, remember what we're looking for. We're looking for this N is equal to 10, I is equal to 3%. And therefore, if you look at here, it should be 8.53020. That is the factor we're going to take for our calculation. So let's take a look at what we have here. So this is the first number I take, and I get this from table 4. Okay. Table 4 present value of the ordinary annuity. Next one, we're gonna looking for the single sum, which is actually on the table 2. Again, let's take a look at the time value money table. Okay. Table 2, present value of the single sum, and I is equal to 3%, N is equal to 10. Okay, you can see here the factor is 0.74409. And that's the factor we're gonna use. Okay, let's just switch back. So this number is what we have. Okay, after you get this 2 factor from time value money table, then we're gonna calculate the present value. How do you calculate present value? You just take the cash interest 4,000 multiplied by the factor, it's gonna give you the present value of the interest. And you take the principal multiplied by the factor, it's gonna give you a present value of the principal. Then you add these 2 together, the sum is the present value of the bond. Okay. That is also what we call the carrying value at the time of the issuance. And that's how we're going to put in our amortization table, January 1st, 2012. Now, to be able to do the journal entry, especially for the interest, and we need to start and finish the amortization table. But first, we need to identify, do we have a premium or discount for long-term liability? How do I know? Just think about it. The face value is 100,000, right? And now the present value is 108,537, which means you get more than the face value. And essentially the net amount you're gonna receive is higher than the principal of the bond. And then we said you have a premium because you get more than you have on the face, right? And so here we can amortize the amount of premium. It's very important if you're gonna take a test or doing homework, and a lot of times they don't tell you it's a premium or discount. So you have to be able to tell by yourself. Okay. All right. So let's take a look at amortization. That's the first. The second one we're gonna do will be the next time when the interest is actually paid. July 1st, 2012. It's a different format. July 1st, 2012. Cash interest is 4,000. Here it's not going to be interest revenue. Actually, it should be the interest expense because we're writing the journal entry for the liability. So interest expense is equal to the carrying amount multiplied by the real interest. That's 3%. Just remember here is the beginning balance of the carrying amount. And this amortization really doesn't matter which value minus which value. It's very important that you want to make sure this number is positive. So always take the larger one minus the small one. So you can make sure you have a positive value here. So now next, you want to actually reduce the carrying amount by subtract the amortization portion. So here, a lot of students ask me, say, how do you know I'm gonna reduce, not actually add to the carrying amount? Because I know at the end, what you wanna have is $100,000 face value. Therefore, if you want to go from 108, 537 to 100, the only way is to going down. Okay. So we can just stop here. You don't need to continue to do it. And if you want, we can just keep doing the same thing. Okay. Just actually drag this. This one has to equal to 4,000. Okay. And then you just keep doing this until the end. You will have $100,000 as your face value. For the journal entry here, you're going to start with January 1st, 2012. And the journal entry is just going to be cash. That's the present value you receive at the time when you issue bond. And here it's going to be a bonds payable. Very important, bonds payable, regardless what the present value is, it should always be the face value or the principal of the bond. And you can see here, you are going to have another account on the credit side to keep it balanced. So we call it a premium on bonds payable. Okay. So next journal entry you should have is on the July 1st, 2012. So for this journal entry, you actually pay out the cash for 4,000. And here, the reason you pay out the cash is because you have interest expenses. You can see here what we're doing is we actually just taking the numbers from our amortization table. And the key here is want to make sure the account names match what you have on the amortization table. Okay, so here if we're gonna amortize the premium, and you know the account you're gonna use is the premium. Okay, they're gonna have debit and debit and credit. Just remember, since we're using the table to calculate present value, there will be slightly different from when you are using Excel or financial calculator. Using table are less accurate, but that's the only way as CPA will let you use it when you take your CPA exam. Bye-bye.